Hello, welcome to session 2. Before we get started on session 2, we're going to review what do you know. But here's the fundamentals of session 2. Don't you like that gator? That's street art near where I live. Today and in session 2, we are going to analyze financial statements. We're going to common size them, and which is also known as vertical analysis, and we'll also do horizontal analysis, and we'll spend a lot of time on ratios, and then we'll talk about how those ratios are impacted by the transactions you make. And then we'll go on to module 3, where it's all about cash flow. So session 2 is the first two things here, and session 3 or module 3 is about cash flows. So let's get started. What do you know? Well, if I'm hearing you shout out, I would say you know that assets equal liabilities plus shareholders' equity, if it's a corporation, plus revenue minus expense. And the first financial statement you prepare is the income statement, which is revenue minus expense. The second one has to do with shareholders' equity and is either the complete shareholders' equity or the statement of retained earnings. And then you prepare the balance sheet, or BS. We also know the debit credit rules. We know that assets are increased by debits, credits decrease assets. We know that expenses, or the other side of that equation, act like assets, and all the accounts in between, liabilities, shareholders' equity, and revenue, act the opposite as far as the debit credit rules. We also know that debits are neither good nor bad, and credits are neither good nor bad. They're just like having a noun and a verb in a sentence, so that you need a debit and a credit to make a complete thought, just like you need a noun and a verb to make a complete thought in a sentence. The other things we know is we know the accounting cycle. And the accounting cycle says daily we make journal entries, and we post those journal entries into, for our purposes, T accounts, also known as the ledger, and that we make sure that we copy correctly by preparing a trial balance. And the trial balance proves that the debits still equal the credits after you've copied them from the journal into the ledger. Doesn't mean you copied them right, but you just copied debits as debits and credits as credits. And you do this every single day until you get to the end of the period, in which case you need to make adjusting journal entries to kind of get everything in its right place. I always say it's like cleaning your room. You need to look at your expenses and say, is everything that's expired or consumed in these expense accounts? Or do assets only contain things that have future or potential value? Or are those liabilities? Are those liabilities the responsibilities I owe to others? Or have I discharged some of those responsibilities or earned some of those responsibilities? So we make adjusting journal entries to kind of clean up our books. And we also post those adjusting journal entries to the ledger. So now everything is in its proper place, so we can prepare our financial statements. And we know the first one we do is the income statement, followed by shareholders' equity or retained earnings, then balance sheet, and finally cash flow. Once we've prepared those financial statements and distributed them out to our external owners, we can get ready for the next year, which means we're going to make closing journal entries. And closing journal entries, we know, close our income statement accounts and our dividends accounts to zero them out so that when the sun comes up on a brand new year, the next day, we are ready to begin again by accumulating what happened during this year, not what happened last year, but what happened this year. So closing journal entries zero out our revenue, expense, and dividend accounts. And of course, we also post those. Now, once we've made our closing entries and posted them, we do one last trial balance, and that's called the closing trial balance. And the closing trial balance only has in it asset, liability, and shareholders' equity accounts, all of them except for dividends, because dividends is zeroed out. So we know all these things. Well, let's see what else. Well, we know that balance sheets are at a moment in time. So they kind of answer the question, how are you? So when someone comes up and says to you, how are you? They're asking for that moment in time how you are. Just like a balance sheet, it tells you about your financial health at a moment in time. Between those how are yous is what happened. And the what happened piece is the income statement and the statement of shareholders' equity. And we know that we prepare the income statement first because we're interested in the difference between the revenues that were earned that period and the expenses that it took to incur those revenues. So income statement, revenue minus expense, that net income then gets included in retained earnings, and then we're able to do the balance sheet at the end of the period. And what we're going to see later in this series of lectures is we're going to learn more about the statement of cash flows. So is she BS? Moment in time, how are you? Versus what happened during the period. Last time we did just this year for the new company to prove again that is she BS, and we found we did the income statement first, statement of retained earnings, and then we were able to do the balance sheet. And this is if you had also done this problem for the next 3 years beyond the first year of operation. So you can study this at your leisure. The other thing we learned is once we know how to do journal entries and post them to the ledger or to the T accounts, we can play CSI accounting, where if we know a beginning and ending balance or a series of things about a particular account, we can figure out what's missing. And that's sometimes called reverse engineering or CSI accounting. And so we've done them for accounts receivable, wages payable, prepaids, unearned liabilities, property, plant, equipment, and accumulated depreciation. So these are all the things we've learned so far.